Welcome to vTalkInsight / 2013 Allocators Lens Daily for April 14th, 2026. A renewed energy shock in the Gulf is colliding with sticky inflation and fading hopes of rate cuts, while major equity indices trade close to their highs. We will unpack how that tension is playing across equities, rates, credit, foreign exchange, and commodities, and what it signals for cross-asset risk in the near term. In equities, the main tension is between powerful earnings and thematic support on one side, and a sharpening energy and inflation shock on the other. Despite oil moving back above $100 and ongoing Middle East risks, U.S. indices are hovering near record levels, with the S&P 500 having recovered the drawdown around the recent U.S. / 2013 Iran flare-up. Volatility gauges have eased from their peak earlier this month, underscoring how quickly risk appetite has returned as investors refocus on profits rather than geopolitics. Underlying that resilience is a very strong earnings story. Major Wall Street firms still project around 11% profit growth for the S&P 500 this year and index targets in the mid-7,000s, assuming inflation drifts near the low 3s, the Fed stays broadly on hold, and 10-year yields stabilize around the mid-4% area. Current quarter earnings are highly concentrated, though. A handful of large technology and semiconductor names, including leading memory and graphics chip producers, account for roughly half of expected S&P earnings growth, which leaves the broader market more vulnerable if those leaders stumble. Sector performance has become very uneven. AI hardware and data center plays continue to lead, helped by rising enterprise demand and large cloud providers ramping capital spending. Banks and other traditional sectors are starting to talk about early efficiency gains from AI as well. At the same time, there's been a sizable rotation from growth toward value. Large cap value indices are up solidly year to date, while growth benchmarks are down, and more than half of the broader Russell 3000 is at least 20% below prior peaks. Energy, materials, mining, and consumer staples are attracting flows, whereas many software, cybersecurity, and rate-sensitive names, along with airlines and travel stocks, are feeling the drag from higher fuel and funding costs. Financials illustrate this push and pull. A major U.S. investment bank just reported record equity trading and very strong underwriting and advisory fees, helped by active capital markets and healthy client activity. Yet its shares fell because fixed income trading disappointed and expectations were high, reminding us that a lot of optimism is already embedded in financial stocks. Across the sector, large universal banks are seen as fundamentally strong and broadly benefiting from a higher rate backdrop, while some regional players face more pressure. Trading-heavy franchises may gain from episodic volatility, but management teams remain cautious in their guidance, given geopolitical and policy uncertainty. Positioning adds another layer. Institutional investors remain defensively tilted and systematic strategies are closer to neutral, so any sustained improvement in the macro backdrop could still fuel incremental risk-taking and extend the equity advance. The key risks come from the energy and inflation channel. Oil has more than doubled from last year's lows, airlines are cutting unprofitable routes and raising surcharges, and higher gas prices are already squeezing lower-income consumers even as high-end spending stays firm. If the Gulf blockade persists longer than the 1 to 2 month window many expect, equity investors may have to reprice both margins and global growth, especially for Europe and energy-exposed industries. Recent inflation surprises have also revived days when bonds and equities sell off together, weakening the hedging role of duration and leaving portfolios more exposed to equity drawdowns. From here, breadth, sector rotations, and upcoming earnings from consumer, travel, and banks will be critical signals for how sustainable this equity resilience really is. Turning to rates, markets have moved decisively away from the idea of imminent Fed cuts. Persistent inflation pressures, now running above 4% on an annual basis and accelerating, together with the latest oil spike, are leading some participants to discuss the possibility of an insurance hike rather than easing. As a result, the prevailing narrative is higher for longer. Long-term Treasury yields are seen as vulnerable to drifting higher, and the curve could steepen if short-end policy expectations stay anchored while term premiums rise. The current inflation mix is dominated by supply-side shocks. Energy, shipping, and even non-petroleum import prices are climbing, while structural forces such as tariffs and fragile supply chains add to the backdrop of more volatile inflation. In this environment, central banks face awkward trade-offs. The European Central Bank is expected to maintain a firm stance against accommodating higher inflation, supporting long-end yields. Yet aggressive hikes in response to oil could be seen as a policy error that deepens already slowing growth. In the U.S., some warn that long bonds and inflation expectations still underprice geopolitical and energy risks, especially if the Fed seems too willing to look through oil-driven price rises. One consequence has been a break in the traditional negative correlation between equities and government bonds. Recent inflation data triggered sessions where both asset classes fell together, which complicates portfolio construction for allocators relying on duration as a recession or risk hedge. There is occasional discussion of potential policy coordination to cap long-term yields, but that carries its own risk of unanchoring inflation expectations. For now, survey and market-based long-term expectations remain reasonably stable, offering some comfort that a runaway spiral is not yet in play. The next few months of core PCE, import price data, and growth releases will be pivotal for how far the higher for longer narrative extends and how much additional term premium investors demand. In credit, the picture is split between liquid markets that still look relatively calm and private markets that are under growing strain. In public markets, investment-grade issuance is expected to reach on the order of $40 billion this week, indicating strong demand for yield and easy access to funding. High-yield spreads have narrowed meaningfully from their March highs, and recent tightening suggests improved risk sentiment despite macro and geopolitical concerns. At the same time, some allocators argue that spreads, while wider than the absolute tights, are not yet compelling enough to draw in substantial new risk capital. History also matters here. Spreads remain tight by longer-run standards relative to the level of geopolitical tension and energy-driven inflation risk. In prior episodes, starting from similar spread levels have often led to lackluster credit returns over the following year or so. That gap between benign current conditions and elevated forward risks is leading some to treat credit more cautiously than equities, especially where duration is significant and compensation for default and liquidity risk looks thin. Under the surface, private credit is where the stress is building. Defaults in the space hit record highs last year and have not eased as much as some had expected. Redemption requests at certain funds are reportedly being met only partially, raising the risk of forced selling or valuation pressure if outflows persist. Exposures are concentrated in riskier borrowers, including many technology and AI-related companies, and insurers now hold close to a fifth of their bond portfolios in private credit alongside municipal and high-yield obligations. That creates potential transmission channels to the broader financial system. The large U.S. banks, however, continue to report relatively modest credit loss provisions and resilient balance sheets, suggesting that any stress remains contained for now. Bank earnings, insurer disclosures, and developments in private credit liquidity will be important indicators for whether the containment holds. In foreign exchange, a structural story is unfolding alongside the usual risk-on and risk-off swings. Over roughly the past decade and a half, the dollar share of global reserves has fallen from about 60% to the mid-40% range, and reserve managers are no longer consistently buying dollars on weakness. That points toward a gradually more multipolar currency system, where the dollar still dominates, but with less automatic official support during periods of stress. It introduces new uncertainty into how global funding markets behave when shocks hit. At the same time, today's heightened instability in the Middle East, Ukraine, and other flashpoints is continuing to push private capital toward U.S. dollar assets because of the perceived safety and depth of U.S. markets. That supports the greenback in U.S. securities relative to many emerging markets, even as official reserve portfolios diversify. Recent dollar strength has largely come from investors covering earlier underweight positions, which now look closer to neutral. The next bout of risk aversion will test how strong the remaining safe haven bid really is in a world of slow-moving de-dollarization. Elsewhere, idiosyncratic political developments are driving currency moves, such as the Hungarian forint rallying while the euro weakens, and the Bank of Japan's cautious stance keeps attention on the yen's sensitivity to energy prices. For allocators, FX remains a key transmission channel for regional shocks rather than a one-way trade. commodities, and energy in particular, remain the central macro swing factor. The United States is preparing a naval blockade targeting Iranian ports and potentially the Strait of Hormuz, with plans described as impartial to ship ownership, which could remove a large share of global supply if fully implemented. Already, an estimated 13% of global oil and 1/5 of gas supply have been disrupted for several weeks, and roughly 13 million barrels per day are reportedly off the market. Hundreds of ships are stranded near key choke points, while insurers are reluctant to provide cover amid new tolls and sanctions risks. Headline crude benchmarks have surged back above $100, but physical markets look even tighter. Immediate delivery barrels in parts of Asia and Europe are trading at very large premiums, with reports of deals in the $140 to $150 range. Shipping costs from Middle East to Asia have soared to around $18 per barrel, more than 10 times pre-war levels, and European airports are already rationing jet fuel as refined product shortages spill over from Asia. European gas prices have spiked, and the region's heavy reliance on imported diesel leaves it particularly exposed. The disruption is not limited to crude. Fertilizer exports from the Gulf region, which account for as much as 30% of global supply, and key industrial commodities, such as aluminium, are also at risk. That raises concerns about food security in developing economies and the health of manufacturing supply chains, especially in Asia and Europe. Persistent supply-side shocks in goods, labor, and energy are feeding a structurally higher and more volatile inflation environment, complicating central bank efforts to maintain price stability and increasing the odds of lower global growth if the situation drags on. For now, markets seem to be assuming that disruptions will ease within 1 to 2 months, with benchmark prices still below their all-time peaks. If that assumption proves wrong, further price increases and downward revisions to growth forecasts are likely. There are some offsets. U.S. gasoline demand remains fairly steady. Domestic fuel supplies look adequate with refineries running at high utilization. China has accumulated strategic reserves from earlier buying and export controls, and the European Union is planning to trim energy taxes and grid charges to cushion the blow. Even so, lower-income households are already cutting discretionary spending in response to higher fuel and diesel-driven shipping costs. Airlines are paring back routes and raising fees, and travel-related equities are under pressure. How quickly shipping lanes normalize and whether ceasefire efforts take hold around the Strait of Hormuz will be crucial for the next leg of the commodity and inflation story. Across assets, the picture today is one of resilience on the surface and strain underneath. Equities remain supported by strong earnings, AI, and security themes, and still cautious positioning, even as breadth narrows and energy-sensitive sectors wobble. Rates markets are leaning firmly into a higher-for-longer stance as the energy shock reinforces sticky inflation and weakens the hedging power of long duration. Public credit continues to clear at tight spreads with heavy issuance, while private credit shoulders rising defaults and liquidity pressure that matter for banks and insurers over time. In foreign exchange, gradual de-dollarization coexists with an ongoing preference for U.S. dollar assets as a safe harbor, and commodities U 2013, especially oil and fertilizers U 2013 remain the key swing factor for both inflation and global growth. For allocators, the main watch points now are the trajectory of the Gulf blockade, upcoming inflation and growth data, bank and consumer earnings, and any signs that private credit stress is spilling into public markets or FX. How those elements evolve will determine whether the current balance between risk-taking and caution can hold. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.